Sometimes a single number, just one tiny number, can put a whole multi-million-dollar company on the ropes. Today, we're going to break down how one real estate tech company, Offerpad, just got a really serious warning from the New York Stock Exchange and what it says about an entire industry.
Let's just start with this number right here, 73 cents. I mean, to you and me, that's basically just pocket change, right? But for a company that's traded on the stock market, a number this low, well, it's a huge flashing red flag.
Because 73 cents, that was Offerpad's share price on March 9th, and that price is so low that it's enough to set off all the alarm bells at the biggest stock exchange in the world. So, what happens when your stock price gets that low? Well, there are consequences. And in this case, it meant that for the second time in less than a year, Offerpad got a formal warning that it could get kicked off the exchange completely. So here's what went down. On March 6th, the New York Stock Exchange sent Offerpad an official notice. And the reason was pretty straightforward. For 30 trading days in a row, its average stock price was stuck below $1. That is a major violation of the exchange's rules. Now you hear this word delisting, but what does that actually mean? Well, it's pretty much what it sounds like. The company's stock gets removed from the exchange. The company doesn't just disappear, but it makes buying and selling their shares way more difficult, and it can really hurt their reputation with investors. And get this isn't a new problem for them. It's kind of like a recurring nightmare, because they faced this exact same threat less than a year ago. That tells you this is probably part of a much deeper, more persistent issue. So to really understand why this keeps happening, we've got to pull back the curtain and look at Offerpad's whole business. It's built around this idea called iBuying. So what in the world is an iBuyer? Well, as you might guess from the name, that little I stands for instant, and it's this tech-heavy attempt to completely flip the script on how we sell our homes. The core idea is actually pretty simple. Instead of listing your house, holding open houses, and waiting for a buyer, an iBuyer like Offerpad uses a bunch of algorithms to give you a cash offer, like almost instantly. They buy your house directly, fix it up a little bit, and then try to sell it on the open market for a profit. If you're the homeowner, the appeal is obvious. It's all about convenience. You just go online, plug in your address, get a real cash offer in a day or two, and then you get to pick when you move out. No showings, no last-minute deals falling through. It's meant to be a super clean, simple process. But, and this is a big but, that simple process for you hides a very, very complex and risky business for them. You see, Offerpad's problems are not happening in a vacuum. The entire iBuying industry has been going through some really tough times lately. The dream of iBuying was always to buy and sell houses at a massive scale. But then, when central banks jacked up interest rates to cool down that crazy hot pandemic housing market, the whole model came under enormous pressure. It's really hard to flip houses for a profit when borrowing money is expensive and buyers are suddenly scarce. And the result? It was basically a bloodbath for the industry. In late 2022, huge players like Zillow and Redfin completely shut down their iBuying businesses after losing hundreds of millions of dollars. All of a sudden, Offerpad and its main rival, Opendoor, were the last two big companies left standing in a much, much colder market. So let's zoom back in on Offerpad, because this is where it gets interesting. At the exact same time they're getting this scary warning from the NYSE, the company is sending out some very different, very optimistic messages to the public. So check this out. Just 2 weeks before that delisting notice, the CEO, Brian Baer, was talking about big growth. He said the company is positioned to scale all the way up to 1,000 home sales per quarter by the end of 2026. I mean, that's a really bold, ambitious statement. And that is the key tension in this whole story. On one side, you have the goal, massive growth, 1,000 sales a quarter. And on the other side, you have the reality, a stock price so low it's threatening their spot on the New York Stock Exchange. It's this huge conflict between where they say they're going and where they are right now. So, what happens now? A delisting warning isn't a death sentence. The NYSE has a really clear path for companies like Offerpad to get back into compliance. The big question is, how do they get there from here? Okay, so the clock is ticking. The rules are super specific. Offerpad has a 6-month grace period to sort this out. And to do it, their stock has to close at or above $1 for 30 trading days in a row. If they can pull that off, the threat goes away. So how do they do it? Well, they've basically got two paths. Path number one is the best case scenario. The business starts doing really well, investors get confident again, and the stock price goes up all on its own. But
If that doesn't happen, they have to look at other options, and the most common one is a little bit of financial engineering called a reverse stock split. A reverse stock split sounds complicated, but it's actually pretty simple. Imagine you own 10 shares of a stock, and each one is worth $1. The company could do what's called a 1-for-10 reverse split. After that, you'd only have one share, but that one share would be worth $10. See? The price per share is higher, but the total value of what you own is exactly the same. It's a tool to get the share price up, but it doesn't actually change the company's value. And all of this really leaves us with a much bigger question. Offerpad's struggle isn't just about one company's stock. It makes you wonder, is this whole iBuyer dream of using tech to change real estate just a casualty of a brutal market shift, or is there a fundamental flaw in the business model itself? That's the question the entire industry is watching right now.